Okay, so let's talk about creating wealth. But maybe not in the way you've been told. This is a journey that, while it starts with a dream that pretty much every investor has, but it ends with a strategy that, honestly, most people never even find.
I want to tell you a quick story. Picture this. It's 1976. In a small town in India, a company called Wipro is just getting off the ground. Now just imagine if someone back then had the foresight to invest just 1,000 rupees into it. Any guesses what that tiny investment would be worth today?
Yep, you're seeing that right. A single 1,000 rupee note would have exploded into something around 700 crores. I know what you're thinking, because I'm thinking it too. Man, I wish I had been that person. We all think that. But let me ask you a serious question.
Do you actually know anyone who did that? I mean, really? And even if they did, can you imagine holding on to that investment for nearly half a century through every market crash, every recession, every moment of panic? It's highly unlikely. And that's because, sometimes the hardest part isn't making the money, it's having the patience to let it grow. And that, right there, is where the real secret is.
So, this brings us right to the heart of the matter, doesn't it? We have this incredible dream of picking that one magic stock, but then there's the cold, hard reality of what it actually takes to do it.
Look, when I first started investing, I fell into this trap. Big time. Everybody had a hot tip for me. You got to buy the stock. It's going to be a multi-bagger. This one's going to rocket to the moon. But you know what I learned? The people who are always chasing that get-rich-quick fantasy, they usually end up burned out and leaving the market. The ones who actually build wealth are the ones who focus on getting wealthy slowly by really understanding how the market works.
We all worry about the market, right? Recessions, crashes, big policy changes. And yeah, of course, the market has risks. But the real risk, the biggest danger, isn't in all that noise. It's in a lack of knowledge. If you have a solid, tested system that keeps you in the game, then time stops being your enemy and becomes your single greatest asset.
So, okay, if trying to pick individual stocks is so hard and, let's be honest, emotionally draining, what's the alternative? Is there a way to stay invested, capture that growth, but without all the fear and guesswork? Well, yes, there is, and it's a much smarter way to invest. ETFs.
So what on earth is an ETF? Let me break it down really simply. Imagine you walk into a supermarket and grab a shopping basket. Now, instead of groceries, you fill that basket with shares of the country's biggest and best companies. The Reliances, the Infosys, the HDFC banks of the world. That basket itself becomes one single thing you can buy. That's an ETF.
Just think about that for a second. With one single click, you become a part owner in all of those incredible companies. You're no longer betting on just one horse to win the race. You're betting on the entire race itself. You're not just buying a stock. You're buying a piece of the entire country's economic growth.
Now, you might be wondering, but wait, can an ETF give me those crazy, explosive returns like a single multi-bagger stock? And the honest answer is probably not overnight. But that's not the point. What it does give you is something far more valuable, the stability to stay in the game for the long haul. And like the saying goes, this game isn't won by the fastest sprinter. It's won by the one who can last the longest. ETFs give you that staying power.
Now, to really use ETFs to their full potential, you first have to understand what they're built on. It's kind of like needing a map before you start a journey. And in the market, that map is drawn by something called an index.
When I first heard people throwing around terms like Nifty and Sensex, I was completely lost. But over time, I realized it's actually pretty simple. An index is just a number, like a score. It measures the average performance of a group of top companies. So if the top 50 companies are having a good day, the Nifty 50 index goes up. If they're having a bad day, it goes down. It's basically the economic thermometer of the country.
And here's the cool part. Since ETFs are designed to just copy these indices, you get all these amazing choices. You can go really broad and invest in the whole economy with a Nifty 50 ETF, or you can be more specific. Let's say you're really bullish on the banking sector. Well, you can buy a banking ETF. Or maybe you're excited about a huge trend, like the whole electric vehicle revolution. Guess what? There are thematic ETFs for that too. The whole point is, you're not trying to guess the one winning company. You're investing in the entire trend you believe in.
Okay, so we've got our foundation. Now, let's build on it. What if I told you that your money could be working for you in 3 different ways, all at the same time? No, it's not magic. It's a more advanced strategy, for sure, but it's incredibly powerful. I call it the triple compounding system.
So here's how it works, in 3 steps. First, you invest.
You buy and hold your core ETFs. This is your long-term foundation, the seed you plant. Second, you pledge them. This just means you use those ETFs as security with your broker, kind of like using your house as collateral for a loan. The broker then gives you a margin, which is basically borrowing power. But, and this is key, without you ever having to sell your ETFs. And third, you can use that margin for disciplined short-term trades to generate a completely separate stream of income.
So let's just break down the power here. You've got 3 engines running at once. Engine number 1, your main ETF portfolio, just sitting there, growing and compounding over the years. Engine number 2, the extra income you're making from those short-term trades using the margin. And engine number 3 is when you take the profits from that trading and reinvest them back into your main ETFs, making them grow even faster. See, it's one pool of money, but it's working in 3 different ways for you.
Now, I have to give you a really important warning here. Using leverage like this, it's a double-edged sword. This system only works if you are incredibly disciplined. You absolutely cannot let fear or greed make your decisions. This is a strategy for people who are consistent and stick to their plan, because the number 1 rule is you must protect your core capital, always.
All right, finally, let's talk about what might be the single hardest skill in all of investing. It's not about what to buy, it's about knowing when to sell. It's the art of actually taking your profits.
I learned this the hard way. I once had a stock that was doing great, just going up and up. I was so happy, I just held on. I kept telling myself, just a little bit more, just a little more. And then, of course, the market turned, and poof, all those paper profits just vanished. That day, I learned a crucial lesson. Taking profits isn't about perfectly timing the market. It's an act of pure discipline to control your own greed and protect what you've earned.
So here's a simple framework to help you do this logically. 1, always know why you're buying something before you even click the button. What's your goal? 2, have a simple rule, like maybe after a solid 20 to 25% gain, you consider selling a portion to lock in some profit. 3, watch the market. Money moves in cycles. Pay attention to which sectors are getting hot and think about where that money might flow next. 4, all your decisions should come from your plan, from logic, never ever from fear. And 5, the most important rule of all, recycle those profits. Put them back to work to keep that compounding engine roaring.
And this really gets to a fundamental truth about the market. Money never, ever sleeps. It just rotates. It's always on the move. The IT sector might be booming this year, but maybe next year it's pharma. Smart profit booking is just about moving with that flow, taking some gains when a sector is high and reinvesting them into the next one that's just starting to warm up.
So I'll just leave you with this final thought. We've talked about how you can buy the entire market, how you can make your assets work harder, and how you can strategically protect your gains. Now, take a second and think about your own strategy, and just ask yourself this one simple question. Is your money working as hard as you are?